Manishi Raychaudhuri is with us. He's Chief Executive Officer, Emmer Capital Partners. Manishi, good to have you here. Thanks very much. I have a slightly macro-ish question, because micros we can get to in just a bit. That tobacco tax increase by the government that we saw, revenue collection for the government is under pressure. I mean, I think we can all agree to that because of the numbers that we get. Do you think we will see more attempts at shoring up revenue? Some believe perhaps the focus will be sin goods, liquor, etc. I mean, it's not as if some of the state finances are also extremely stretched. What's your sense, Manishi? Is that a signal? I mean, you can also take that argument to oil. An excise increase. We don't know if it will happen, but it sure is chatter. Go on.
Right. Thank you very much, Prashant. Good morning to you and a Happy New Year to you.
Happy 2026.
Absolutely. Thank you. Right. So, I think government revenue, and consequently the fiscal deficit, the potential for the fiscal deficit to increase is a real challenge. It's a real concern. And that is something we have to look forward to in this budget as well. And what you pointed to, that is increase in taxes in certain consumption segments, that is a very real possibility. I would be happier, and this is something I would be looking at keenly as far as this budget is concerned. If there are, kind of non-tariff or non-tax revenue sources that can be tapped by the government, maybe monetization of more government assets, maybe a few more privatizations. If the resources are raised through those non-tariff, non-tax sources, obviously that's the best outcome. But otherwise, it's a very I would look at it very keenly, that how the government plans to close the potential fiscal gap going forward.
Manishi, since you have this entire emerging market bias, based on what we've seen geopolitically, are there any implications for your, for any of the emerging markets? For instance, you're overweight Hong Kong, China. You sort of increased your weightage on India. Any thoughts on how this impacts the way you thought about emerging markets, the development?
Right. So, what we've seen over the last few days underscores one clear driver of 2025 that's going to continue in 2026, and that's geopolitical tensions. It's a new normal that we have to live with, that geopolitical tensions are here, and consequently, we're going to see increasing defense expenditure. There are plays on that in India. There are possibly larger plays on that in Korea, and those are something that we are banking on. We're also going to see the impact of that in commodity prices. We already saw the so-called safe haven trade, or the debasement trade in terms of gold and cryptocurrency in 2025. We are going to see more of that in 2026. And even in some of the base metals, that is likely to seep through. We are possibly entering a kind of a commodity super cycle. I mean, I kind of hate to use that word, super cycle, but a strong commodity cycle going forward. While we have seen that in precious metals, we are going to see that, and we have partly already seen that in 2025 in the base metals, and possibly at a later date in the ferrous metals also. So those are some of the important themes, debasement trade, geopolitical tensions and defense expenditure, and commodity prices going up, that we have to focus on in 2026.
Okay, all right. Manishi, just hold on to that thought. Info Edge, the December IT sector hiring is up by close to around 8%. Explains why that stock, in fact, has perked up today. And in fact, the insurance sector recorded a 34% overall increase. So just pull up the intraday chart. The stock is unmoved for the last month or so, but in today's trading session, it's perked up. And just one more sector of stocks that we're looking at. We had mentioned just before market opening that yesterday the street was a little bit troubled about the CCI probe with regard to steel companies. But in today's trading session, these stocks actually have bounced back up, because it will be very difficult to prove the legalities with regard to that. Tata Steel is holding more or less flattish. SAIL has pulled back some of the losses that we saw yesterday. And JSW Steel as well, the last time I checked. That stock as well, after starting off in the red, it had moved into the green, as is the case with Jindal Steel. So all these stocks, they're pulling back a little bit from the lows. Hi, Manishi. Good to see you, Ben. The next few days, the tech numbers start pouring in. Tech and real estate, the two worst sectoral indices of 2025. Would you bet on them in 2026?
Now, tech is something I'm still keeping away from. Indian tech is a classic AI loser, and I had used this phrase earlier on your channel also, and I'm sticking to that point of view. At some point, as a consequence of these AI investments, the IT services would also have to pitch in to, kind of coordinate and link all this massive investment that's going on. But that time is not now. At least in the near to medium term, over the next 6 months to 1 year, we will possibly see the threat of AI replacing the coders of the Indian IT companies. That concern would possibly be stronger than the potential benefits to the IT companies that could come later. Real estate is something different. I would be selectively positive over there. There are various ways to play that. One could even play the real estate positive sentiment through some of the banks in India. But it did well between 20 to 24. Then 25 was not quite a good year. But I think some of these laggards of 2025 could bounce back selectively in this year.
You spoke about commodities being in a super cycle, and already last year we've seen some big gains. At what point will the inflation start hurting automobile companies in India, or even the renewables play? For instance, you need a silver, copper, etc. in solar panels, inverters, etc. I mean, what are your thoughts on the adverse impact of this commodity super cycle? And to play the commodity super cycle, do you have a view on Indian metals?
Right. So I'll answer your second question first, because that's a lot easier. We are playing the commodity super cycle theme through copper and aluminum. Not so much through the Indian companies in our model portfolio. We have more exposure, larger exposure in China. The likes of Zijin Mining or China Hongqiao, which are into copper, aluminum, also some of the gold plays in that market. These are not only companies with stronger growth forecasts in terms of earnings growth, but also a lot cheaper, than the Indian counterparts. Now, having said that, I think in terms of when we have a situation of a super cycle, pretty much every boat tends to be lifted up. And we would see some parts of that in Indian companies also. Your first question is a bit more complicated, and it's not easy to take that call right now. Certainly, there would be an impact on the margins of the commodity users. So we have to look for those companies which are in a position to pass on their cost increases to the consumers. So we would, in all these consumer discretionary, automobiles, these sectors, we would have to look for the market leaders who have the necessary pricing power to pass on their cost increases to the consumers.
Okay, all right. Manishi, what about this FI holding year in India? 2025, all through the year, we kept saying that their holding is declining. It's declining even more. And towards the end of the year, ended at the lowest we've seen in multiple years, more than a decade. Yeah. What's your view with regard to the kind of interest that we're seeing in the Indian markets? Valuations are not cheap, but it's never been the case. We underperformed the MSCI emerging market, by the highest margin all the way since 1994. And their holding is at, very low levels. Growth should come back. Earnings growth should come back. Do you think we welcome back some FI flows in 2026?
Right. So, you're, again, coming back to your original question, what is the reason behind this, the lack of enthusiasm on the part of the FIIs? Equity markets are driven by three basic factors: their earnings, their interest rates, and currency. In the emerging market context, currency is also an important variable. Now, in case of India, it's only one of these factors which are possibly right now on a positive note, where you have earnings estimates or where you have interest rates declining and possibly likely to decline even more in a benign inflation scenario. But the other two factors, the currency and earnings, they have not been in India's favor. And we think that they will, and on the other hand, we're seeing earnings estimates reviving in North Asia. Asia, ex-Japan itself, the consensus EPS estimate has moved up about 4 to 5%, driven largely by North Asia, China, Korea, Taiwan, etc. So for FII interest to come back on a sustainable basis, those variables will have to be stabilized. Earnings estimates will have to revive. The currency will have to stabilize. There are several factors that could drive these. We have seen part of that in 2025 with a lot of fiscal stimulus being thrown in India. The currency, well, no one knows when the trade deal, the US-India trade deal would finally be signed. That could be a trigger. So many of these building blocks would have to fall in place before sustainable FII interest comes back.
One final question, it'll lead into the next discussion that we're having. Do you own any of these quick commerce, Eternal, Swiggy, a pre-placement perhaps in Zepto? Because there is this standoff between the company, the platforms and the union. There was this large strike which took place on the busiest day ever on 31st of December. And the union is demanding social security, higher wages. If that comes, maybe not to the extent the union is asking, but even if there is any increase in the costs for these platform companies, it questions the profitabilities, it'll hurt. I mean, is that a big risk for platform, the shareholders of people who own a Zomato and a Swiggy? How are you reading it, the developments?
So, in our model portfolio, we don't own any of these, the Swiggies and Eternals of the world. And, I think the manpower-related concerns that you point out, they could hurt these companies, but I think it would be a short-term impact. The bigger story for these companies is the long runway, the long pathway of market penetration that they have still ahead of themselves. In the process, if we have a degree of valuation correction, I think that would actually provide a buying opportunity for investors who don't own many of these companies.
What's the extent of a correction that would interest you, make you buy a Zomato or a Swiggy? A 10%, 20% lower?
I would say it's possibly closer to 20% than 10%.
Got that.
By the way, markets are still treading water, right? 40 odd points lower, sideways, and just about sort of going around. It's not decisive, let's just put it this way. One other name, right? We're talking about Senco and Kalyan and Titan. The smallest of the lot is Tribhuvandas Zaveri. That is 10% higher, TBZ. So every few years, TBZ wakes up and makes a big, massive move and then sort of, goes right back to sleep. I'm not sure if that is what is happening here. But I mean, I think that perhaps would be close to an accurate description of what the stock does. MCX is up 3%. So 23.10 after it underwent that split. Stock set basically pretty much highs on MCX. Precision Wire, lots of names. I mean, Natco is up about 3%. I think we highlighted MV, which is the Jefferies had initiated coverage yesterday, day before yesterday, 6.5% again this morning. GM Breweries results reaction, it's up about 3% or so. So it's not a bad-looking broader market screen. Yesterday, of course, was a bit of an aberration where the headline frontline indices were sulking, but broader markets also sulked, which wasn't the case the day before. Thank you very much, Manishi, for joining us. It's always a pleasure having you with us here. And once again, wishing you all the best for 26.
Thank you. Thank you very much.